Hi, I'm Ross from Smith Property Accountants, and we've got a big problem coming up for property investors, and it's all about our provisional tax due the 28th of August. This is for property investors who are affected by interest limitations. So if you've got new builds, you've got social housing, you're a business owner, this issue is not going to affect you. This is for the ones with interest limitation. So for interest limitation, there's a big flaw in the provisional tax, and it means that your provisional tax calculation is potentially not right, and some tricks I'm going to talk about later on how to delay it. So what's the big issue? Well, 2023, if you've got no exemptions, existing property, you could claim 75% of the interest. 2024, we're down to 50%. 2025, we're back up to 80%. So 75, 50%, 80%. So the problem is if we file those 2024 tax returns, we're basing our provisional tax on 50% interest limitation. But we know it's already a fact from the 1st of April 25 that it's going up to 80% interest limitation. So what's going to happen is we're going to end up paying a whole lot more tax than we need to. So I'm just going to start sharing my screen and we'll run through the example and we'll run through the solutions for this. So this one, we've got 3 years. They're all exactly the same. We've got 240,000 rent each year. We've got 30,000 expenses. We've got 200,000 of interest. The real profit for this property investor is $10,000 in each year. Interest limitation. So for the 23 year, we could claim 75% if it was existing property, no exemptions. We couldn't claim 25%. So there's 50,000 non-deductible. It means our taxable profit, the profit we pay tax on, is 60,000. The 24 year, we can only claim 50% on this type of property. So our taxable profit goes up to 110,000. 25 year, we know it's back to 80%. So there's only 20% that we're not claiming. Our taxable profit is down to 50%. This is presuming our expenses and interest all stay the same, which obviously they don't, but it's to make the example easy. And what we're seeing at the moment, if anything, is interest has been going up. People are paying more, not less. So obviously, if there's more interest, then you're going to have less profit as well. So with our tax due, I've done it at 33% for an example. 23 would be 19,800. 24 would be 36,300. 25 would be 16,500. So you see the problem. If we pay provisional tax, if it's based on the 23 year, so we haven't filed our 24 tax returns yet, it's based on the 23 plus 10%, we'd pay 21,000. That's still more than we're expecting at 16,500. If we file the 24 tax return, then the standard provisional tax calculation is 24 plus 5%, means we're paying 38,000 of provisional tax over August, January, and May. So we'd be paying 38,000, but we'd only be expecting 16,500. I don't know why I've got that zero in there, but that's all right. So expecting 16,500. So we would be paying a whole lot more tax than we really need to, and that's going to affect your cash flow. So tip number one is we want to keep our provisional tax if you're affected by interest limitation based on 2023. So easy thing is don't file your tax return, delay it until the 20th of January 25. That's after the second provisional tax. So then what will happen is under normal prov tax, if we haven't filed, our August 24 provisional tax would be based on 2023 plus 10%. So that would be 7,260. Whereas if we filed 24, it would be 12,705. So we're paying about $5,000 too much. Whereas we really expect it should be 5,500. So we are paying a bit too much in August. But the thing is, if we are not estimating and we're just paying the standard tax based on 23 year, we haven't filed our 24, there's no interest, there's no penalties, there's no risk. If for some reason the profit goes up and we pay these in August and January, no penalties, no interest, no risk to it. Even if profit somehow jumps up, we're not getting penalized for that. So that's basically our best trick is delay filing. Don't file your tax return until after the January one. So that means we would pay our August one, 7,260, slightly too high, but it means there's no risk, no interest, no penalties. Then we'd pay the January one, 15th of January 2025, 7,260. Then we're looking at, we would then file our 24 tax return. IRD is then going to be looking for this 36,300 tax due plus the 5%. So provisional tax is based on last year plus 5%, 38,115. We've only paid 7,260, 7,260. We're going to be a long way short, and they're going to be looking for a huge payment. But what we would normally do is in May, we would look at it and go, okay, we wouldn't use that calculation. Instead, what we would do is we would look at what is our real profit going to be. So we're looking at 16,500 as our tax that we're expecting for the whole year. We have already paid 7,260. We've already paid another 7,260 in January. So for our May installment, we would pay the difference, which is $1,980. That would be the payment we would make on 7th of May 25. And we would not estimate again. So by not estimating, it means if we've got it wrong, so somehow that figure ends up being more, you somehow have a property sold or something comes through that you weren't expected, and hopefully by 7th of May 25, you already know about that. But if we've underpaid, we can just go to tax management. We can borrow that extra from them. They put the money in 7th of May 25, perfectly on time with IRD, no penalties, no interest, and then we pay a little bit of interest to tax management. So 2 key tips. Don't file until the 20th of January 25 if you're affected by interest limitation. So we'll pay our prov tax based on 23 plus the 10% uplift. And then for the 7th of May 25, look at what your profit is, review what's happened, work out what your real tax is, and pay the extra, maybe with a little buffer if you like to be conservative. And then IRD is going to show you owing tax, but as soon as you file your 25, it's going to wash up. Yeah. If you're slightly short, we then use tax management because we have it estimated, and you'd pay a little bit extra. So yeah, hopefully that's a lot to go through and it's quite complicated, but like I say, 2 key steps. One is if you're affected by interest limitation, delay filing your 24 tax return until the 20th of January 25 or after the 15th of January 25 provisional tax payment. Don't estimate your 7th of May 25 payment and just pay less. And yeah, good idea probably to get your 25 tax returns done reasonably quick. Make sure you see what the wash up is, if anything is due, and then you can quickly pay it through tax management if needed. Last thing, if you're someone who was on 0% interest limitation or 0% interest deduction, so you purchased an existing property 27th of March 21 or after, you're getting no interest deduction, so you're not a new build or social housing or something like that. It's a residential property, not a commercial. What we would then do, you're going to go from 0% interest limitation to 80%. So what we would probably do is either pay 0 if you know there's going to be no profit. So pay 0 in August, 0 in January, and 0 in May. And again, we wouldn't estimate, you just pay lower. Or if you know it's going to be a lot lower than the provisional tax, what you do in that case is just pay a lot lower. And then if it's wrong, we can use tax management to fix it. So hopefully, yeah, that's given you a few different ideas. If you have a look at our newsletter, we've got the same in writing, and we've got an article that will link to this at some stage as well, so you can read through that as well, and it's probably worth watching this a couple of times. But yeah, the key concept with it is just to be careful. If you're affected by interest limitation, your provisional tax calculations are not going to be right. They're going to be flawed, so we can do the 2 tricks. We can delay filing until 20th of January, and we can also look, don't estimate, just pay less. So hopefully you found that useful. Thanks a lot. Bye.